Hello everybody, Randy Patrick here. Time for Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Tuesday, the 27th of August. Yeah, we got back-to-back videos going on this week already. Reason being, today is a good news day as far as stuff in the real estate industry, and that's what we're going to talk about. So topics today are Case-Shiller statistics were released this morning. We're going to go over that. I've got some information on July foreclosure statistics. And we'll also take a look at Orange County, the home buying situation there and what's going on in Orange County. So again, lots to talk about. So basically, the main information here is home prices are rising at the slowest pace since 2012. And I guess you could say the year-over-year home price was about 2.1% based on today's Case-Shiller information that was released. So again, it's the S&P US or whatever. It's US CoreLogic S&P. Case-Shiller Home Price Index, which basically is an index calculation that has a couple of variables in it, a lot of calculations. Typically, this is used as the litmus for today's housing market, and it's just one of those things created by Robert Shiller. He's the co-creator. He's the famous guy who basically put this together, and he gets often, I guess you could say, interviewed, and he discusses the housing market every so often, reflecting what's going on in the Case-Shiller index here. So basically, what we found is that everything is slowing down. So we've talked about this decelerating appreciation. So every month when I look at the numbers, the year-over-year numbers are getting smaller and smaller and smaller, which is interesting. So 17 of the 20 largest cities tracked by Case-Shiller posted increases in housing prices in June. And again, this is for the month of June. It's usually a couple-month drag on the Case-Shiller information, but most of the increases were small. Prices fell in New York, Miami, and Seattle. So that's where we're seeing some movement here. Now, again, I look at those as being large, coastal type cities, right? New York, Miami, Seattle, some of the mega cities that are out there. And typically we do see price erosion. I guess you could say starting in those locations, in the bigger cities, the larger metros, and typically we see that happening faster. So that's kind of the unique stuff. So if we go a little deeper into this, I guess you could say the Phoenix has replaced Las Vegas as the top city in annual gains according to the index here. So that's interesting enough. Everything seems to be trending downward. By the way, I will put a link to this in the comment section, the about the video section. Okay, so you can actually take a look at this. This is produced by S&P Dow Jones. It's on their website. You can look at it in directly there. It looks like the Southwest, Phoenix, and Vegas remain the regional leaders in home price gains, followed by the Southeast, Tampa, and Charlotte. With 3 of the bottom 5 cities, Seattle, San Fran, and San Diego, much of the West Coast is challenged to sustain year-over-year gains. And for the second month in a row, I guess Seattle experienced an outright decline in year-over-year price change of negative 1.3%. So as I mentioned in the last video, when we talked about this about a month ago, we are just seeing this, everything kind of slow down. That's the way it's going. Seattle is actually losing value. Everybody else is still gaining value year over year, but the gains are very, very small. So they're approaching that line, that I call the inflection point, and that's the change. Our national index, if we take a look at the index from peak to trough, so peak being 2006 when we had 2006 here, our peak, and where we are today in 2019, that differential, so that percentage on the index from 2006 peak is 14.1%. So we're still seeing every month a slight increase in that differential. But again, that's based on a national index, and that's still because a lot of the cities are still posting year-over-year increases, although, as I mentioned, they are small. If we take a look at this directly here, we can take a look at the change. Atlanta is up 4.5%. Boston's up 3.9%. Charlotte's up 4.5%. Chicago 1.5%. Cleveland 3.4%. Dallas 2.7%. Denver looks like Denver is 3.4%. Detroit 4.2%. Las Vegas 5.5%. That was down. That's usually up in the 7s. LA is 1.6%. Miami is 2.8%. Minneapolis 3.9%. New York just 1.1%. Phoenix 5.8. So again, Phoenix leads the, I guess you could say, year-over-year appreciation on this month. Portland 2.4, San Diego 1.3, San Francisco just 0.7%. Seattle was negative 1.3. Tampa, where I live here, is 4.7. That's down from above 5 last time around. Washington, D.C. is 2.9%. So the overall U.S. National index is only up 3.1%. That's down from, I think it was about 3.5 the year previously. And when you start digging into some, they get into seasonally adjusted and non-seasonally adjusted. So you look at some of the seasonally adjusted numbers here, that's where you're seeing more and more cities really having, again, New York and Miami and Seattle are in the negatives, and a lot of the other locations are very, very close to being negative. So I think in the next month we'll see what happens. But again, this is June, so this reflects June, and this is how the index works. It usually looks for, we'll call them sales pairs, and what that means is that it takes a look at the house that was sold in June and when it was purchased, and then the price appreciation that's worked into the overall calculation. So it's a big algorithm we're going through here, but I think it's fairly accurate and fairly interesting to review this. But again, when you take a look at the graphs and everything that Case-Shiller produces here, the indices, the trending is going that way. So yes, we still have appreciation, but as they call it now, we have decelerating appreciation, getting less and less. And when I look at the numbers, for sure, they certainly do look, a lot less than they did last month. So again, you had Vegas being in the 7s. It's down now just in 5.7% or 5.5%. So some of these markets now are going to change. Realize that this is June, and to me, the June, July, and August months are still potential months where we're going to see activity, because homes are being bought and sold based on seasonality. And as I always mention, the summer selling season, people want to move, they want to get their deals closed, they want to move in their homes, get their kids registered for school, and off they go. So some locations of the country, we have school already starting. Some it'll happen, starting September after Labor Day. So pretty much once, August hits, we're kind of done that activity, and we're going to see some sales slow down for sure with respect to what's going on. Even though we have despite lower interest rates, we see trending pending sales trending downward. There's less of them, so there'll be less sales. Whether that reflects into property value increases in the end, I'm not too sure. That's still an inventory situation. But again, more and more people are waiting on the sidelines from what we hear and what we read. And again, the index showing itself to be trending in the other direction. So there you go. Now this is kind of interesting. So we've just spoken about the Case-Shiller and the fact that trending down a little bit, but still showing property appreciation. Now we're going to look at the highest and lowest foreclosure rates. So Adam Data Solutions obviously produces their information sparingly now these days, I've noticed. So foreclosure activity fell by 21% in July 2019 year over year, according to new data from Adam Data Solutions, but increased month over month. July saw a 6% increase in foreclosure starts month over month. Now, the difference here, and I want to be clear, is that we have foreclosure activity and foreclosure starts. Foreclosure activity is foreclosure starts, it's auctions, it's REO repossessions, it's things like that. So foreclosure activity is a bigger number and incorporates more things than foreclosure starts. So for example, if foreclosure activity is decreasing because less homes are actually becoming REOs, that means they're either being bought at the auction or potentially homeowners, for example, are doing loan modifications or workout programs with their lenders so their homes don't get foreclosed on and they don't become that peg count statistic. All right, so realize there's always going to be a portion of the, I guess you could say, the foreclosure properties, the status, wherever they are in their process, that will do loan mods, and they won't become a foreclosure, we'll call it casualty. Typically what happens is the foreclosure is voluntarily dismissed and they become loan mod customers. They remain in their home, they just have a new mortgage plan or new mortgage parameters. But as a side note, many people who do loan modifications, a very high percentage will end up redefaulting sometime in the future. So that's something else to think about. So, but I look at primarily, I look at foreclosure starts, because to me, foreclosure starts is, hey, I'm not paid my mortgage, and now the lender is starting the process, whether it's a notice of default that they've filed, or whether it's a, the lis pendens notice of litigation in the judicial type states. To me, that's more the trend to see what's happening in today's market. More and more people are, so that's becoming consistent now. When we look at that by state, the worst foreclosure rates that could be found on the East Coast, of course. New Jersey is the number one for the rate, and what I mean by that is, one foreclosure for every X number of housing units. Delaware is next, Florida is next, Maryland. Okay, and Adam reports that counter to the national trend, and when we say counter to the national trend, the trend is foreclosure activity falling. So that's the overall activity falling. So that's the global trend, right, which includes more than just foreclosure starts. So counter to the national trend, 21 states and the District of Columbia posted year-over-year increases in foreclosure starts, which is filings, which is starting the process. The lender starts that process to eventually repossess their property. That's up 55% in Washington, 44% in Georgia, 28% in Arizona, 7% in North Carolina, Colorado up 3%. That just makes a few examples here. So again, we have 21 out of 50 locations. That basically is still 40%. So last month we had about 40% of states are feeling the effects of year over year, or actually year over year increases for foreclosure starts, and that number is consistent. So if we go back to my Case-Shiller, when it's like, hey, now we've reached another high water mark with our differential between 2006 to 2019, that dollar value there. Why aren't people selling their homes, cashing out, paying off their mortgages, and moving on? It's personal economics, people. I mean, if you sell your home and your non-payment for the foreclosure has eaten away at that equity, which maybe means you can't cash out because there's nothing there to cash out anymore. Or if you do cash out, you're challenged now to go buy a place or go rent a place, and maybe people are, I guess you say people are preferring to wait it out as long as possible in their homes, so they don't actually have to have a housing expenditure. So that's can happen in the marketplace right now. So just realize that by metro area, the worst foreclosure rates in July 2019 were Atlantic City, New Jersey, Deltona, Daytona Beach, Florida, Jacksonville, Florida, Rockford, Illinois, and Fayetteville, North Carolina. So there you go. Among the larger metros with at least 1 million people, those with the highest foreclosure rates were Jacksonville, Florida, Philadelphia, Pennsylvania, Orlando, Chicago, Illinois, and of course, Tampa Bay. So certain locations, you can see having issues. That whole Northeast issue, the Jersey, Philly area. Obviously, Florida, we just have a lot of them. We've got top three locations, and the Chicago, Illinois area, of course, we've known about that for a long time now. So that's kind of the scoop. Additionally, 97% of the 220 metros analyzed the report posted year-over-year increases in foreclosure starts. So we've gone from the state level, we go to the metro level here. So 97% of 220. So again, we're not quite 50% here, but we're above 40%. You've got Atlanta, San Fran, Phoenix, Seattle, St. Louis. So other locations. So 97 other locations of the 220 top metros are posting year-over-year increases in foreclosure starts. So it's starting to happen in other locations. Yes, a lot of the Sun Belt states get it first, just because of the nature of the state and the economy there. Chicago's, the New York's always are going to be leaders, but now we're going to see other locations like St. Louis, Missouri is posting a year-over-year increase in foreclosure starts, which is interesting. Now, bank repossessions ticked up month over month as well by 4%, but decreased 42% year over year. That's interesting. So we're seeing some of the recent foreclosures, are actually hitting the marketplace now. But when you take a look at the year over year, having a decrease in bank repossession, that's because, number one, more people are buying at the auction probably, and again, clients are doing loan modifications or workout programs, so they're not even getting to the point where the bank can repossess it. So, again, that's a good sign for people who are doing loan modifications, keeping their homes. again, the terms and conditions may not always be favorable, but you get to stay in your home. And as I mentioned just a few minutes ago, those are, there's a high percentage of people that can re-default and fall back from a loan mod back into the foreclosure process. So they're not out of the woods yet. So again, this is why I love this marketplace here. On one hand, we still are seeing price appreciation across the board, albeit very small now, and we're seeing it consistently now. This is not just 1 month spike. Now we're seeing a few months of this being about 40% of the metro markets, a little bit more than that, are posting year-over-year foreclosure starts. Simple as that. So again, it's still trending lower. This is trending lower. The values are trending downward, lower, and the foreclosure filings are trending upward. So to me, that means something's going to happen in the near future. All right. So having said that, just talk about Orange County. So every so often we hear about California, what's going on in California, and basically Orange County home buying the first 6 months of this year was reportedly awful. Signals the top could be in as a correction, and the overall California housing market could be nearing. And I guess you could say that the first half of 2019 sales in and around Huntington Beach, Fountain Valley, Garden Grove, and Westminster fell 12% to the slowest pace since first half of 2011. So what we're seeing here is we're seeing various metro locations, various counties, etc., sort of replicate what happened back in the last housing crisis. So, if this is the worst pace since 2011, peak, crash, okay, this is where it happened, the crash. Now, we've gone up, we're seeing home sales actually at post or the previous crash levels, but we're not in a crash yet, which is, so to speak, however you want to look at it. So this is kind of a trend. So what's the trend is people aren't paying these prices here, and it's just interesting to note that the median home price was flat, didn't have any uptick on that. Home sales tanked 9% year over year, and the median price fell 2% in the same period. So there you go. So different locations are going to have different micro market economies, and obviously the California markets we tend to hear and talk about more and see more because there's more written about it because of the sheer volume that's out there, and also that they tend to have the faster or more extreme differences when markets change. But again, this is just a snapshot of what's going on out there. If I take a look at the charts and everything, again, I'll post this link in there, but you can see that someone did a chart here and said inverted yield versus California jobs and home prices, and basically when rates invert, short-term higher than long-term, home price appreciation often slows or turns negative as unemployment rises and recession often follows. So there you go. So very interesting when they track this, everything is tracking, these three things are down. The graph is in the trough here. So very interesting to see that the trends all seem to be lining up right now. So that is it for today. I just wanted to get the fresh news out here. So big news. Case-Shiller, again, we're seeing slower appreciation. Home prices rising at the slowest pace since 2012 at just 2.1% year over year. So there you go, guys. That's a scoop. So again, thank you for the views. Thank you for the likes and comments. Please share the video with your friends and family. Post it on Twitter, do the things, Facebook, whatever you want to do. Certainly helps the videos grow. If you're not already a subscriber, I'd appreciate you hitting the subscribe button because I'd like to put out this information, help you with your home buying endeavors. And speaking of which, if you want information on my Never Pay Retail program, still holding out a little bit for a few people who are trying to decide to get in at a great discount here. The whole idea is to give you guys information as to what you can do to save money when purchasing homes from both a retail and investment perspective. I've got that program going on right now. If you want more sophisticated or advanced training on short sales, because I can tell you over the past couple of weeks, the number of inquiries that I've been receiving on short sale opportunities has increased dramatically. That is a marketplace where you can find, I guess you could say you can find better price discount properties. They are a little harder to get your hands on, to be honest with you, but it's a market that is untouched and underserved, and I can prove that, and I can prove it right now when we take a look at the NAR, National Association of Realtor When they post their monthly statistics every month on existing home sales, we just see 2% of home sales across the board attributed to distressed properties. Half of the, part of those are real estate owned, REO bank owned, and the other part is short sales. And short sales are typically less than 1% of the marketplace, which means the market's underserved. Nobody's helping the people in need, and that's the biggest opportunity sitting there right now that no one's touching except me. I'm going after that, and you guys should be too. Anyway, thank you very much. Look forward to speaking with you. Just reach out to me if you want to talk more about these fun subjects, and we'll probably get at least one more video up before week's end. Thank you.